Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant here, co-host of Investing Insights with our very good friends at the Right Property Group. In the studio with me this afternoon, it's when we're recording, Mr. Victor Kumar and Stephen Waters, Esquire. Gentlemen, how you going? You well?
Esquire.
Esquire.
It's a new term for the new year. I'm not sure what it means.
I think he's been Googling over the Christmas break, right? He's learned a new word.
Expanding the vocabulary. Yeah. But, thank you for asking.
Well, no, it's a term of respect, I think it was.
You were going to say endearment then, weren't you?
Well, no. Then I stopped myself because it's not really endearing, because I was probably setting myself up for some sort of comment, which I don't know. Oh, there's something in there anyway. No, Steve Waters, Esquire. It's an old-fashioned term for a landed gentleman.
Well, there it is.
Sorry, is it landed or rounded?
Rounded gentleman. No, landed. Let's not body shame. It's not very nice. It's the new year and all that. I mean, it's absolutely appalling to pick on your colleague that way, and we don't encourage that sort of behaviour on Investing Insights of the Right Property Group. What sort of behaviour we do encourage on Investing Insights of the Right Property Group is common sense. Do we need the office defibrillator? I think young Stephen here is in a spot above that. We encourage good behaviour on this podcast, Stephen. That's about being a more informed, better educated, a better property investor, and we've been doing this now for a couple of seasons, and we enjoy getting together once a month to see what's going on in property and hopefully apply some of the principles and strategies that you do every single day in the work that you do with your clients, and freely share that information so people can embark on that themselves. And we'll get toward the back end of the podcast. I think you guys are going to make a nice offer to potentially sit down with people that want to start thinking about 2020 and what property means for them. So tune in towards the back end of this podcast and we'll let you know how to go about doing that. But you only get to do this once every 10 years, start a new decade, Stephen. And 2020, most people are familiar with 2020. Normally means some sort of, you look forward about with vision and clarity, your eyes crystal clear, knowing where you're going, or with the benefit of hindsight, you can look back and consider where you've been and how that might shape where you're going. So I thought we could lean on this as our guiding beacon for this particular podcast and help shape our discussion. 10 years we've got ahead of us in this decade, and we spoke a lot about this at the mid to later part of last year. And I know you guys have been sort of coined this term for many years ago, this design your decade type of thing. So don't think about property as in what's happening tomorrow or what next year is like. You need to be thinking in blocks of 10. I guess, and again, we spoke about this, most market cycles, depending on who you listen to or what the experts say, 7 to 12 years. So, if you sort of balance it out to about a decade and you start thinking in 10-year increments, that's probably the right way to go about it. So here we are, start of 2020. A lot of our listeners have been in the game for a while. They've got large portfolios and they continue to grow those. But you've also got a lot of people who are new to the market sort of tuning into this. So
there's a lot of information out there, isn't there?
There is.
Via platforms like yourself or whoever, but there's a lot of potentially misleading information. And I think just coming back to the design a decade.
Is it design a decade or your decade?
Your decade.
Your decade.
Design yours.
Design a, largely the same.
It is. But importantly, it's not just so much about the result at the end of the decade. It's the fundamental steps you put in place so that decade plans out nicely for you. And being able to pivot, being deliberate, but it's a plan, essentially.
And the constant check-ins. Where do you check in? What do you check in terms of what you're planning to achieve in the decade? And especially when we're talking 2020, we've got a reset, which is we've got a 0 in our number, right? For those that are into numerology, I'm not, but it's something.
You're more sort of astrology, are you? You sort of read the paper and when's your birth? What, are you in Aries?
No, I'm a Gemini, mate.
What does that mean? Sorry to stop you. This is important. There's like property professors and stuff. Maybe you're the...
This week will bring romance and wealth to your...
Gemini, mate, I'm the perfect yin-yang, right? Okay. Literally. So... But coming back to, since you sort of rudely interrupted me, Phil.
Yeah, sorry.
If you look at 2020, we've got a 0, which is a reset. So we're starting off resetting again. And we're resetting on 2 levels. One, obviously, it's a new year. So we're resetting for this year, looking at our goals, our resolutions, and what steps we need to take. What can we achieve given what's the playing field for the year, but also importantly for the decade as well, because we're getting a clean start, which is on a finite number. And we can say that by 2030, this is what we plan to achieve. And then we reverse engineer it from a portfolio basis, from your income basis, and it basically bring it back to yearly, quarterly goals and build it up back from there.
Milestones
Along
that's
right.
the way.
Yeah.
And you just mentioned 2030.
I also, God,
I know that sounds like way out there, but it'll go in a flash.
Yeah, exactly.
And that's the point, I think. Whilst it might seem like, I've got to wait 10 years to get some sort of result, or even 15 or 20 years, it will go quickly.
Will the 20s be good for property investors?
20s be good.
Because we're talking about decades, right? And again, it's always going to be, it depends what you do, but...
Any decade's good if you approach it correctly.
Let's talk about market conditions. We're starting this decade with record low interest rates. Lending's getting a little bit easier. At least serviceability requirements have come down. We have a government in place which has given us some certainty moving forward. Is it going to be good?
I think it will be, but not for everybody, as we've said before. I think for some it'll be exceptionally good, and for others it'll be same old, or even deflammatory in their own personal circumstances. But if you even look at, I think the CBA put out a report yesterday saying that the number of new loans is at nearly record highs, or go back to 2010 or whatever it was, don't quote me on that. But what that importantly does is it's showing a sign of the wealth effect starting to resonate and emanate out. And that's because of low interest rates. People are maybe starting to feel a little bit more secure. But what I found interesting was that retail spending was also at its lowest ever. So there's a yin and a yang in terms of what the economy fundamentals are showing. And so what that does is that has potentially certain markets in flux. And when there is a market in flux, or even a decision to be made and a hesitation that goes along with that decision, there are opportunities for investors. Now, that's potentially looking a little bit too deep and making it a little bit too complicated. To answer the question, do I think it'll be good? I think that the next couple of years are pivotal to get either started or either to consolidate wherever you're up to and to take advantage of the conditions that we have today and how to set yourself up in the future. But that doesn't mean every market. I think there are some markets out there that are being perpetuated by self-invested interests, if you will. And I think people need to be careful.
So looking, we're talking about 2020, and let's look backward with that and with hindsight, which is a great spot to be. When people think back at the decade that just happened, now, if I go back and think about when people talk about the 90s when it comes to property, people are going to go, interest rates were at 16% or something or other. It was pretty hard graft. The economy wasn't doing very well. There's a lot of this, that, and the other. But decades get identified in a whole bunch of different ways, but whether it's music or whatever, but when it comes to property, they get their own identity as well. When people think back on the decade just past, how in 20 or 30 years' time, what do you think they're going to be talking about? How are they going to describe this decade that we've just had when it comes to property?
I think two ways. A GFC.
Yeah, that's right. GFC was last decade,
And then I think they're going to be talking about these record highs / affordability issues that the Australian real estate market had as a general rule, because a lot has happened in the last decade, and mountains of changes, scenarios. We had royal commissions, we had record growth, we had affordability issues, we had a GFC, the back end of that. Lending.
I think we had about 1,000 prime ministers.
Yeah. And opposition leaders.
Yeah.
And we had almost record issues with obtaining finance at one stage. And I think people tend to forget that there is so many scenarios over the last decade, and the next decade will be no different.
True.
There'll be just as many changes in whatever shape or form. It's the preparation that allows you to pivot at each of those major changes that the next decade holds is where the goal will be.
Yeah. I think what we need to do is perhaps split it up into, if you're starting or just starting your portfolio and beginning the investing journey, what do we do this year and in this decade, and how do we prepare for it? And if you've already got a sizable portfolio under your belt, what do you do now, right? So let's start with the investors that have already got a couple of properties under their belt. Perhaps this is the time to batten down and start looking at restructuring your mortgages as the finance starts becoming easier, to be able to, first of all, free up any equity so that if there are opportunities coming up in the coming years, you are ahead of the curve in terms of you've already got the money. So you're not trying to get from a standing start, you're already moving in that sense because you've got a large portfolio. So it takes longer with most lenders these days with the amount of paperwork that you need to give to them. So if you take all three of us, to get a loan is a couple of months process, if that.
A couple, not 6.
It's not something I look forward to, Victor.
Yeah, that's right. So for someone that's got a sizable portfolio, that's the first thing you need to do is look at your mortgages, look at which ones are coming off interest only. And if they are coming off interest only, perhaps even take a deeper dive into it and say, all right, is this coming off interest only, and does it make sense to let it revert to principal and interest, because the difference between your interest only component and principal and interest isn't substantial, and a lot will depend on the loan size, obviously, to actually work that out. And perhaps you need to, apart from freeing up the equity, start thinking of mortgage retirement as well, the debt retirement side of it as well.
Correct. And it's an interesting question. We get asked that a lot. Should I go to the principal and interest with the attractive rate or keep it interest only? And whilst there's always individual circumstances, generally speaking, if the household budget can afford it and you're not in a purchasing phase, then why not take advantage of the lowest rates that you possibly can and use that as a the part of the pay down cycle, if you will. But I think always try to get the money before you need it.
As we keep saying it every single time.
Trying to get it when you need it, and just everything turns upside down for you. So being liquid, being prepared all the time, I think is essential.
That's right. And then perhaps for someone that's already got a portfolio, you may want to change tack, in the sense that if you continue buying the same type of property, the same areas, perhaps you're making your portfolio a bit too top heavy. You need to start thinking of, okay, where does this lead? We are in record low interest rates right now. But historically, interest rates are around the 5 to 6% mark. And whilst we can't predict the future, we don't know, but we know for sure that the interest rates will go up, and it'll go up to about the 5 or 6%, perhaps even higher, right? So we need to start looking at it and saying, okay, if it does do that, if I'm buying the same types of properties right now and keep on adding to my negative cash flow without mitigating the risk if the interest rates do go up, how am I going to hold on to my portfolio at the time when everyone else is struggling, and at the time when it will become a lot harder to qualify for loans as the interest rates start creeping up?
So we're really talking about balancing the portfolio.
That's right.
Which means different
asset types, different
property
areas.
types, perhaps even different asset classes.
Yeah, absolutely. Yep. And perhaps even stop buying as well. Take a break.
Yeah. So we're talking about designing your decade. So with all this in mind, people will be going, okay, that's cool. I'm going to start doing something today. But so we're talking about 2030 or 2029. Let's get our crystal ball out. What's Australia look like in 10 years? What's the property market look like in 10 years? There's a lot of stuff we just don't know. But
there is.
You can look to history for clues of how a decade might look. So we've got to be thinking about, what Australian property will look like in 10 years. And then, me 10 years on, I'm still going to be working, but I'd like to think that I probably don't have to be working, but I choose to. No, I don't. I just speak to blokes like go out to lunches, One of the best jobs in Australia.
Sir Lunch-a-lot, eh?
Sir Lunch-a-lot, you can tell. But, Australia's going to look very different, in 10 years. The population, we can go and get the numbers, and we should maybe put this onto the website. But you've got to understand and appreciate where you're going to fit within that, both professionally, personally, your ability to generate income, what sort of lifestyle you want to have.
What changes there might be. But it's hard to think 10 years ahead.
That's true.
It is, but you mentioned something quite substantial, saying there are clues. And I think if you took you guys, Momentum Media and Smart Property Investment, that if you pulled up stories in 2028 and reviewed the last 8 years, they'd be pretty similar to the 8 years that have just been. So we know that you'll be talking about interest rates and how they've gone up. We know that the whole argument about affordability will raise its head again. So there are clues that it's just history repeating itself.
I completely agree. And it's only just yesterday I did a podcast for Smart Property Investment where we did the top 10 stories of 2019. It could have been 2009. It could have been 1999.
Yep, 100%.
It was, you could verbatim put it in there and not change a word, and it could be identical. Like some of the details in the stories might be.
Well, the trigger points were different, but the result or the headline was the same.
Same headline, same introduction. You could write it time and time.
And it will be the same again. So, Vic, you mentioned interest rates before. We know they're going to go up. I know people are talking about a long-term forecast of a low interest rate environment, but I don't buy into that. And I think when interest rates go up, they'll go up pretty quickly. I don't mean to 8%, but there'll be a couple of bumps, pretty quick. So being prepared for that, so creating your portfolio or having levers or strategies in place to combat that when the time is right is essential, because at that point in time, the state of your wallet will dictate the state of your mind without fail.
Absolutely. And if you look at it from a time perspective, and I know we're only talking a decade, but one of my clients that I had secured a property for Christmas was doing a renovation. And Craig Burgess, if you're listening, thanks for sending me that article. Under the carpet, he found newspaper pages from 1968 and pricing on properties. One that really sticks out to me was Campbelltown in New South Wales. Your deposit was $50, and it was the caption was get connected to the sewer, underground power, and have an Olympic-sized pool at the entry of the estate. And your total purchase price was $3,800 something, right? Now, when we look at it today, we think, geez, $3,500, $3,800, that's a bargain. But the reality is that most people back then were probably earning $10, $20 a week, right? So $50 was still not affordable in that sense on a weekly basis to have the deposit. So the initial deposit was still hard to save up.
Finance was hard?
Finance was hard, yeah, because you actually needed to know the banker. And for our female investors, if you were investing back then, good luck. You would not get a loan. You needed to have a male with you. Times have changed, certainly. If you look at the monthly payments, it was $17.50 from memory. But it's all still relative. We've moved to bigger numbers. We're still saying it is hard to save up a deposit. We're still saying that it is hard to find affordable properties in the right areas. Nothing's changed. The only thing that's really changed is how we're getting our money, how easily we are able to get the money, which is both a good thing and a bad thing. But also what's also changed is the information that we get, the manner in which we get the information. So as we're going into the next decade, I think more and more, everything's going to move digital, and research will become easier, but equally importantly, it'll become a lot more problematic because you won't be able to decipher what is true and what is not, and still comes back to the basics where you actually have to be on the ground. You have to actually know what's real and what's fluffed up data, and make sure that you're buying well within your means in terms of affordable property that is affordable to you, and not necessarily in terms of a price band, but more so in terms of what you've set yourself up in terms of the goal for the next 10 years, and making sure that every property you add to your portfolio is complementing the properties you already hold, and is also enabling you to hold the entire portfolio without compromise to lifestyle, and perhaps enabling you also to buy your next one.
Hypothetical, Victor. So, the point I take from what you just said, and it's really, really pertinent, is you got to put everything into context and put it into perspective. You're talking about the 60s and newspapers. I remember we did a reno with you guys in St. Mary's, and we found all those newspapers. I remember sitting there flicking through them, exactly the same thing, adverts. You just go, look how cheap this is. But, hypothetical, if you had a time machine and you could go back to the 60s, or you could be where we are today, and with the purpose of creating generational wealth, would you prefer to be where we are now? Would you prefer to be where you would be in the 60s, knowing what you know happens from the 60s in terms of stupidly high interest rates?
I've got news for you. I'm actually from the future.
Are you?
Yeah.
It all becomes clear.
I've come back because
Marty McFly.
I just saw a spoof advert of Victor sitting there with his calculator and
Flux capacitor.
So you've actually come back to this time.
Because it's very affordable right now when I compare 100 years done.
But you know what I mean? It's always going to be horses for courses, right?
Yeah.
But was it better then? Because if you think back at Sydney in the 60s, let's say where your offices are out at Bellevue Hill, that was a country. Bella Vista was a country,
Yeah.
Blacktown was the fringe of, I think the train line only got in there and whatever, or the bridge across, at least there at Seven Hills where I grew up. But it was a very different place, right? Was that where all the good opportunities were then? They don't exist anymore because it's been built out? Or every decade, and we're talking about designing a decade, every decade has its own dynamics, which is just the ongoing growth and development.
I think the fundamentals, I think yes, but the fundamentals are the same. Like if you go back to the 60s where you could have bought in a city for, $60,000, well, you compare that to today, it's
about the same though, isn't it? Really? Like relevance of
the amount of zeros are different.
Yeah, but they talk about now the median house takes 10 times the average. I can't remember, 11 times the annual, which is how the World Bank measures Australia, says it's overpriced, right? Back then it was very different. but attitudes toward debt was very different.
But back then, only one person was on the loan.
Yeah.
Back then, the standard of living was different. Back then, education was different. Back then, they were still carving up land and giving it to soldier settlement blocks.
Yeah.
So I don't think you can really take a leaf out of yesteryear's book that far back and just verbatim say, well, let's just double down on that because it'll be the same forever and ever and ever. There are always different trigger points. The world as we know it is evolving. But it's in our DNA as an example to own the principal place of residence. But that is slowly but surely changing.
I think home ownership in
Which
the
is where I was going.
2020s versus home ownership in the 60s is probably very different.
Very different.
Very different. And it will continue to change. Yeah, we might end up somewhere like, I don't know, New York, where most people rent. Yeah, who knows? But I don't think that's the case, but you certainly got to account for it. The world is evolving at such a fast pace where you just can't think that everything is going to be the same as yesteryear.
Yeah. So gone are the days where you can have a 30, 40-year strategy, hence coming back to the design your decade, because the goalposts in terms of what is achievable and what you can buy and what you can do with it and where you can buy is changing rapidly along with the information. So that's why you need to condense it back to a decade rather than have your traditional approach of a 40-year strategy, buy 1-2 properties, don't worry about paying down debt, let it grow immensely in value, the debt will be minuscule. I think that's gone out the window now. And really what we all should be looking towards is outright ownership in property in some way, shape or form, right?
Absolutely.
So that way you're immune to your interest rate fluctuations. You're immune to what the economy is doing to a degree because you don't have your major overhead, which is your interest rate component on the loan. And if you started thinking of it that way, the way you are investing, where you're investing, and what you're investing in will start changing as well. And you will then start foregoing the traditional approach and start looking more towards, okay, what does this mean to me in terms of lifestyle? What does this mean to me in terms of the income that it'll generate? Not necessarily the equity. But then also, equally importantly, therein lies the problem because most people try and get to the income too quick and they don't set their foundation right. You need to set the wealth in first. So you need to get the strategies and all that and implement that first, then unencumbered by implementing the higher strategies. So if you're looking at investing in a 10-year time frame, perhaps the first 3, 4, 5 years is all about accumulation and resetting the portfolio. Then the following 5 years may be a hiatus of either going back and implementing the strategies on the properties you already own or just battening down the hatches and starting to pay down those mortgages so that you're not constantly in that buying phase.
So if we explore that a bit further, because and just to really make the point clear, we're not talking about a result in 10 years.
No.
Right? So that's not what Design a Decade is about. And Victor mentioned that every property has a reason for being in the portfolio. So if we look at the way we first started investing, we don't invest like that anymore.
No.
And we wouldn't encourage anybody to do that, which was just a matter of set and forget, so to speak. So now it is more about buying the right types of properties in the right types of area, all those normal fundamentals that we should all know, but it's about what the outcome of each property is, so that when we do get to those times of consolidation and that the cash flow is apparent, that we are in a situation where we are not needing, we're not wanting, because
Correct.
we want time to do its work.
Yeah. Initially, when you're investing, the potential is that the investing will actually lock you back into your job because you actually need that extra income to hold on to the portfolio. But the idea is that you want the portfolio to neutralize relatively quickly. Now, the quickly depends on your time frame, not necessarily my time frame, not necessarily what the books say. It's your time frame. You need to neutralize it relatively quickly so that the property growth, the property pay down happens in the background and you continue doing what you're doing, whether it is, developing your career, whether it is going and start self-employment, whatever it looks like to you, that's what you need to do. Investing needs to happen in the background.
So what hasn't changed is cash flow management.
Exactly.
Is still king. Correct.
And what we're talking about here are the fundamentals of investing, and whether it's the 2020s, whether it's the 1960s, or whether or not you're going to go back to the streets of ancient Rome, borrow money, don't borrow too much, be able to pay your debt back, and at some point in time, own the asset outright. That's the stepping stones to wealth creation.
That's the goal.
But there are so many. It hasn't changed, but there's been so many different filters put on that, and especially as technology evolves, being able to make it look sexier and cleaner and fizzier and what have you, because people have evolved strategies as they have been successful. Now, some of that success may have been a moment in time because of what the economy did or what the market did, but nothing has still beaten time over debt, productive debt, and then paying it down is where the wealth is.
Look, it's speaking that way as you're talking thousands of years, right? Like it hasn't changed, right?
It hasn't
changed, and it probably won't change too much. The how might, but the process is consistent. But we're talking about 2020, and each decade is identified by a particular set of themes or situations or whatever it is. 40s was influenced by war, as a big determinant of that particular decade, 1940s, for example. So 2020, considering the basic fundamentals of wealth creation, which is what we're talking about, what do you think we need to be keeping in mind or in our back pocket as we approach this next decade, designing a decade that might shape the way in which you might make investment decisions? So the economy, you go really micro or macro with this stuff, America's relationship with China and how that might have power play and how that might translate into markets or oil prices or whatever. You can go that deep. What are the sort of stuff that gets to investors? That's probably should be saying the new investor to the street is building out a decade, an investor who currently has a portfolio. What are the headlines that you need to be across, do you think, for the next 10 years? So that's a hard question.
Yeah, so let's strip away the normal fundamentals of location and da-da-da-da.
Yeah.
For me, I think it's people are more and more, we'll call it outsourcing, and becoming reliant upon different facets within the industry, call them team players, if you will. I think that will evolve more.
For the better?
I think for both. I'm probably boxing myself into a corner here, but I think in some areas it'll be a lot better. And if we just look at what we do in terms of advisory and what have you, I think it will get better. And that might be through regulation and what have you, and we want that, bring that on. However, I also think there'll be some sectors of the overall market that will be very, very grey. And one of those areas for me is around data. As we know, data is king, and there are many collection agencies. And I think as AI gets better and we're able to collate that, people will rely upon that more, and then they'll start to jig the algorithms and what have you, and people will become just reliant upon what the data and the algorithms
So you're talking about outsourcing responsibility, and that's detrimental.
Correct. And I do. That's where I think that's where the problem will be. And so
don't use the machine too much.
Don't use the machine. Never advocate the responsibility. At the end of the day, the responsibility of yours, and it's a multi-million-dollar business, so dig deep and be real with it, no matter what technology throws to you. So technology for me, if you want to overlay it, will be massive. But I also think there's going to be a story somewhere in the next decade when rates get back to, let's call it 5% or thereabouts.
And there'll be a reset in the market again.
Yeah, and there'll be a lot of things that were, this is the way we should do things back then, but now that rates are at 5%, it's just a flawed strategy, whatever the asset may be. Which then comes back to me, just with all the glitz and the glamour and everything else like that, just don't steer away from the fundamentals, right? It's as simple as that. Cash flow management, I know I say it a million times, location, asset type, quality, but more so than ever, responsibility.
I think one of the things that we need to be mindful of in this decade is this is the decade, in my opinion, of over-information. And coming back to what you said, Steve, we need to get back to the fundamentals, get it to a physical attribute in terms of, making sure that you physically eyeball the property, you're making sure that you are thinking the strategy through rather than basing all of your decision on photos on the internet, which if you look at most photos on realestate.com, the cloud patterns are the same. There's actually Photoshop furniture in there. The grass, even though we're in a drought, is absolutely green.
Actually, sorry to interrupt. If you just go back to our social pages, say Facebook, we put up probably, maybe 4 or 5 examples of horrendous photoshopping, or good photoshopping, but horrendous.
Yep.
And you shouldn't have done it.
It's like your personal page, right? Where one day you're in front of the Eiffel Tower, the next day you're at the, the bullfighting in Spain, and the photoshopping is great, but everyone just knows a little bit, how's your father, right?
Yeah, I know. Whereas yours, it's more about, personally.
Yeah.
Lost 30 kilos.
Yeah, it is, but let's have a chat about that. You're talking about technology and how technology can be an enabler, but it can also, if used incorrectly, can be a hindrance. If I look back at realestate.com.au 10 years ago to where it is today, a decade, it It's not that different, to be honest with you. It does pretty much the same thing. It's got a few more features and benefits and stuff. This is sort of new wave of technology, prop tech, if you want to call it, which is for people that work within real estate or people who buy real estate. And that's accelerating, that's changing rapidly. But how do you make sure your relationship with technology isn't a negative one that makes you a less effective investor? How do you know if you got that relationship wrong?
Look, I'll bring it back to how we do things, and we use just about every facet of technology that's available and have had for many years. We use every data collection house. There's not anything that we don't use that everybody else uses, and that's the secret. Everybody uses the same collection agencies. It's how we interpret the data. And I think
using the experience of the yesteryears.
The skill of interpretation is where the gold is. And you can only get that via many years of doing it, but also ground truth, which is what we've said a gazillion times, because data is just an indicator. It's not the truth.
And having said that, technology does help, right? We are moving more and more into the digital space. So as an example, settlements of property before used to be paper-based, and you actually went in with a settlement agent, and if they missed a check or if they bank A settlement officer didn't meet up with bank B settlement officer, settlement doesn't happen, it then gets rescheduled for the next day, you get copper fee. Now it's all on PAXA, which is electronic, and you can keep postponing your settlement every half an hour because it's all electronic. There's no physical person going and everything's electronic, right? So that's something that certainly made property transaction easier. I think it'll get easier still as purchasing does happen. We've got a lot of agents that are now starting to move on to digital signatures on the contracts and all that sort of stuff. But what it also does, it takes away the tangibility of buying property. It takes away the tangibility of signing on hard paper, being able to physically write out a check. And so the enormity of getting into debt is lost more and more. And people are just seeing that as fantasy money that I just got to come up with this, then this.
I'm glad you said that, because it's taking the emotion out, the physical emotion out of purchasing. And I know that there's that golden rule where, you should take all the emotion out of when you're purchasing investment properties are just numbers. But I challenge anyone, and there'll be very few people that can absolutely eradicate all emotions when purchasing a property.
Emotionless investor.
Yeah.
Sounds like the term for Victor's next book, right? The emotionless investor. He's come from the future.
But he's showing emotion now. But truly, you think about the last time when you signed loan documents for $1 million.
Yeah.
There was an element of emotion attached to it, whatever that looked like.
Yeah.
Well, if you're inspecting a property, there's an element of emotion. And if you go back to your example of
everything's digital.
Everything's digital. It is a tick and flick scenario. Correct. So where that might play out is, to a lesser degree, a banking inquiry, but within the real estate industry, because so many things have gone wrong.
That's right. And to bring it to real life perspective, right? We've got, we tap our card when you're buying coffee as an example. Compare that to, say, probably even 5 years ago. We had to pay across physical notes, right? And when you're paying across physical notes, you actually felt like you're parting with your money.
Different relationship with money.
Yeah, that's right. Yeah. Whereas you're tapping your card, it doesn't feel like you've actually spent the money.
I do that now with my phone. I tap.
People just put their watch like that.
My wife does that. Yeah, it's just ding. That was simple. One of the things we say about feeling stuff is, and when we do the reviews with our clients and we help them set up that initial purchase or ongoing purchase, and we would have done the same with you, is we would like you on your first couple of purchases to not have the real estate agent pay all the bills for you. We physically want you to pay your own bills so that you get to know what it feels like and get muscle memory, if you will, on that this costs that and that costs this, and that you've got to pay it on this quarter and on that date. And once your portfolio gets to a couple or whatever it may be, and you're used to and you know what and you understand what the expenses are, then you can hand over. But imagine if it was just all taken away from you to begin with. You would have no physical attachment in any way, shape or form to the property, and I think that's where the problem will lay.
Absolutely. I agree.
Let's fast forward 10 years and let's make the commitment now that we do a podcast, irrespective of what happens, you know, and hopefully we're still doing investing insights in a decade's time, but let's make sure we get back together.
I'd say you'd be replaced when you look outsourced.
We'll outsource Phil.
Technology might have taken over, right?
What do you mean?
Robo-Phil.
In a Zimmer frame.
But like, you know, we come together in 10 years and we spoke about you talking just a Royal Commission into the real estate sector. That might happen, right? You know, we'll get together. You probably arrive in your flying car or whatever, and you know, Victor might be the Prime Minister. You know, stranger things have happened, right?
He's led a coup again.
I'm talking about Australia, not Fiji.
So am I.
Another Fiji. We don't need another Fijian coup. Yeah, we had one for a while, by the way.
No, we'll let Australia do it now.
Yeah. Hey, thanks so much also for, I know you still identify being Fijian, for sending over that help with the bushfires and stuff as well. It's really cool to see, you know. Anyway, noted. 10 years' time, you know, like we'll come together and have a chat about this and see what this looks like, you know.
See how it's played out.
Has technology really changed things that much? Like, I'm just trying to work out what else can fundamentally change that much that would change the conversation we have in 10 years' time.
I remember having a conversation when mobile phones came, well, they hadn't just come out.
The Philip Fizz.
Yeah, the little flip-top ones where you went as small as you possibly could. And I remember having a conversation with another person saying, surely we are at a saturation point in terms of technology.
This is it.
Yeah, like can it get any better? Like, can we get any smarter, quicker, faster? And yeah, that was probably 15 years ago. And look where we are today. I mean, my iPhone's got more power in it than my first computer. Like, it's
Your iPhone's got more power than what launched the space shuttle, the guys to the moon the first time around. Right?
Correct.
You know?
Yeah. And so 10 years, I think we're just starting to get going.
I think the fundamentals won't change. It shouldn't change. It's how we do it and how we transact will definitely change. How we derive our mortgages, how we apply for mortgages will change. It's already changing, and a lot will become more and more digital in that sense. And as people our age go on to retirement and the newer generation comes in, they wouldn't know paper-based contracts and all this. Everything will be electronic. So then they will become the new era of investing where it's not tangible anymore. Then some guru will come up and say, no, you've got to make everything tangible, and there'll be a reset back then again. And
it'd be cool to be a retro property investor.
Yeah, exactly.
You can dust off some of those clothes you got in your attic, mate. You'd be right on the money.
Well, I'll come back from the future again.
He doesn't have to dust them off. He wears them every Friday.
So we're being futurists, and that's quite good fun. Just thinking, I'm driving my car, listening to us have a chat about this. It's all very entertaining, engaging, and I'm going, okay, well, what do I do then? Like, you've just made it harder for me to make a decision about this decade ahead. So to your point around having an A team and making sure you're drawing on the right people, support your investing through wealth creation, that's very much the stuff that you do. And you support me personally, but and I enjoy chatting to you guys about this. I said at the start of the podcast that you guys are happy to start maybe helping people tackle some of these type of scenarios and issues they need to be chatting about. How do they get in touch with you guys to make that happen?
So questions at rightpropertygroup.com.au is where they need to send the email to, and maybe just put on the header podcast offer.
Okay.
And if you're a beginning investor, you've just started your portfolio, maybe you've got just one or two and then you don't know which direction you need to get to, we'll point you in the right direction. And if you're already an established investor, we can do a full portfolio review and again point you in the right direction as to what we need to do to achieve your goals in the next decade, and certainly help you steer away from potential minefields as your portfolio grows larger, given the changing economy, the changing environment, the changing landscape in terms of property investing, so that we can first of all draw on our years and years of investing in different cycles, in different modes, in different states, and also draw on our expertise of being on the ground on a daily basis, looking at the minute changes that are happening so that we can pick on the changes before it becomes common knowledge or obvious knowledge, and then obviously make sure that we are correcting the portfolio accordingly.
Yeah, and go to the website, put in the, podcast offer. But while you're at the website, there's literally hundreds of pieces of information on their blogs, videos, whatever it may be. In fact, the last podcast, because Phil took a sickie.
He was overindulged in the Christmas grog. That's what it was.
Wasn't it beforehand? Oh, yeah, it was too, yeah.
Mate, I haven't had a sick day in a decade. I designed my decade over a decade ago and said I'll never take a sick day. I haven't had one since.
Good worker when you can find him.
Yeah. Mate, do you know what I was doing? I was trying to learn about property. I was on the ground truth, exploring the world, see what's going on.
At Jackson's on George.
It's not there anymore.
Isn't it? Really?
Well, it's there, but it's getting built around. I think they're not going.
that right?
It's actually a site office for the new big building that's going up there.
That's a shame.
Yeah, it is.
Anyone who knows Jackson's on George knows what we're talking about.
Upstairs, late on a Friday night. It's
And
horrible.
Saturday.
But
Sorry, so go to the last podcast, but on the website you'll also see we did something different. We recorded it, not like visually. It sounded a bit stupid, but just something different. So have a look at that. That's probably about 40 minutes worth of recording, but some pretty good information there as well.
one of the most popular things we did last year, Victor, was you guys put together it's like a little template for a portfolio that you made available to all listeners, and I think we broke the internet with that. So I know that is still available, but
Our portfolio tracker? Yep.
yeah, your portfolio tracker. But
I've got
the benefit
something.
of 2020.
I've got something far better this time round.
What do you got?
Well, it's not comparable. They're pretty much on the same
That's a
level
big call
playing field.
considering it broke our
It broke the
website.
net. Yeah. You know how I like keeping things really simple and tangible, right? One of the things I've been using for many years is a really simple goal setting template. And given that you're listening to this in January, perhaps early February, and given that this is the beginning of the year, what I'd like to do is share my template with you, the same template that I use every single year to set my goals for the year. It is a really simple template with really simple instructions, because people tend to make it a little bit too complicated. So if you send an email to us, questions@rightpropertygroup.com.au with the subject title as goal setting template, or even just goals, we will send that out to you, and it's got all the sets of instructions. It's something that's held in good stead for me over many years, and you're welcome to use it as well.
Did you do goals, Phil?
Yeah, I do.
Did you do them this year?
Yeah, I did.
Care to share?
No.
I didn't think so.
None of your business. I'll probably share them organically all the time, but a lot of people say that the best goals to set are ones which are smart goals, right? And I'm going to try and remember what these are. They're specific, they're measurable, they're actionable. And there's R and a T, right? But
We got to smart.
yeah, smart goals. But people say, and it depends how you're wired, and everyone will have their own relationship with goal setting, that for a lot of people it's important for them to document it, and then they need a mechanism for reflecting on it and then keeping accountable to it. And for a lot of people, they tell other people as their goals. So they've got a bit of a connectivity or recourse around it. And I don't particularly need to do that. I'm pretty self-reflective. I'll think about it every day. I'll score my day every day. I'll think about what I did, what I didn't do well, and what I can do to improve. And it's just a perpetual organic cycle for me that I don't actually think about. I don't know I'm actually doing it, but when I'm having a chat like I'm having right now, I go, well, I actually do that all the time. So that's how I do it. But
Nice.
So I've got different goals. A lot of people are life goals and this goal and that goal and that goal. My goal is to get up and do the best I can every single day. And I know if I do that, it's all going to be okay.
Sounds like a Simpson episode.
But it's true, right? That's just my base philosophy with everything, right? I think if you do that, you generally do all right. I don't know. How about you?
I don't like the word goals personally, because I think they become obsolete very quickly. I think it's something in the moment in time that people use that word. I reclassify it as milestones, because a milestone is something, in its true sense, and it's an accomplishment. It's a huge accomplishment.
Well, you reach a milestone, right?
Correct.
Very positive.
And so I put milestones in place. And I'm very much the same. I'll have milestones every day, whether it be just to get out of bed, without being in pain, or get home early to see the kids, whatever it may be. Or it might be that I need to achieve X, Y, Z. But milestones is my go-to.
You? Goals, milestones, or something else? You're from the future, mate.
I'm from the future.
Probably a word that we don't even know exists.
I actually set my what I need to achieve in the year between Boxing Day and New Year's. That's when I do all my planning and all that sort of stuff, and set my milestones, my goals during that, so that come January 1, I've hit the ground running, rather than trying to make a New Year's resolution, because we tend not to be resolute throughout the whole year.
True story.
Yeah. So, and then I have the check-ins every quarter in terms of I need to achieve this at this level in this quarter, and then I reverse engineer. So I'm putting a very finite and short time frame to it, so that you can gather the momentum on it. If you say that this year I'm going to achieve this, then you've given yourself too much time.
There's no check-in points. And like, just not to bring it back to the subject, but I kind of am with the whole designer decade. If you just look 10 years out and you think, well, in 10 years, this will be it.
That's right. Yeah,
By having the designer decade platform, if you will, we're having measurable steps along the way, milestones, if you will. Every quarter not just every year, but every quarter, whether that be a check-in, an adjustment of this or that, and pretty much the same in life.
And we've got to close out, but for you, Victor, you this must be the fourth decade that you've been investing. The 90s, the noughties, the 10s, and the 20s, right? Like when you think about it.
You're not counting the ones in the future either.
Yeah, no, I'm not. But like, it sounds like you've been doing it for ages, but for you, this particular decade, and you as well, Steve, you started investing long before I did. Like this is when you guys should start thinking about really realising those
absolutely
3 decades of work. Like this is crunch time, really, this decade, because of you're not old guys, but you're not young guys. So this is where it's a compliment. You know, you're not in your 20s, right? You know,
I'm
so
not
like
far off.
I'm on a multiple of 20 years.
Yeah, you are. Yeah. But this is it. This is where this J curve goes. Really, when
Absolutely
you see values go up, debt goes down, and
I agree, provided you haven't speculated and provided you have corrected for what the year is offering, what the phase of the market is offering and what the economy is offering, and correcting for the weighting in your portfolio in terms of cash flow and equity.
Good.
There it is.
All right. So round out questions, rightpropertygroup.com.au. Yep. 2 things, goals.
And podcast
offer. Got that sorted out. If I just want to check out these articles that you mentioned, Steve. I've had a look. They're really cool. There's a lot of wealth and knowledge in there. Website is rightpropertygroup.com.au. And social media, just look
Facebook ones and Insta and everything else.
Sweet. Thanks, guys. It's a good way to kick off the decade. And are you going to give me a commitment 10 years' time? We'll come back. We'll listen to this. We'll play some outtakes when...
Have to turn the volume up.
Yeah. You should start investing cochlear, mate. You're going to need those hearing. So, I'll tell you, it's better than Afterpay anyway.
Yeah, well, it is. And I'm glad you mentioned that, Phil, because there's a lot of people out there that perhaps may think that we are trying to influence the market with vehicles like Afterpay. And we absolutely think it's rubbish.
Yeah. Send your hate mail, questions at rightpropertygroup.com. Thanks, guys. Really enjoyed it.
Sorry, Steve G. That was for you.
Yeah. We'll be back in next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.